Good morning.
Everyone, sorry, I just came in. Thank you for having us.
Yes, sir.
Thank you so much for having us in this morning. Just to kind of introduce ourselves, my name is Brett Hollad with Stifel. This is Mike Battistelli with Stifel. And then we also have Brett Agnew, who's a senior advisor consultant with Franklin Templeton, and Corie Hardie. He's vice president, portfolio specialist regarding the large cap growth piece. He's going to be addressing that a little bit today that's involved with the pension. So I just mentioned there about Franklin Templeton, just as a side note. Franklin Templeton purchased Legg Mason, which is one of the managers that we utilize with the pension, a few months ago. And so if you see correspondence with Franklin Templeton, the portfolio and the managers and everything has remained the same. But if you see that name, that's why you see that name. It's we would consider it a non-event at this point in time. So we were just going to take a few minutes, if Mike and I could take a few minutes just to kind of update on the pension, and then Corey's going to share a little more specifics about the Legg Mason piece that he assists in overseeing. So in your booklet there that we shared with you, hopefully you have that there with you on page 1, page we typically go over. In the top left corner of the page, if you will, the combined portfolio, this is just the returns, and this is through September 30th of this past year. Through the quarter, for the quarter, return was 5.64%, and the year-to-date number was January through the end of September was 1.6%, and then a one-year number going back from October 1st of last year through September of this year was 5.92% on the overall portfolio. Then underneath that, we always talk about the allocation with regards to the investment policy statement and so on. The allocation as of the end of this report was showing equities there of 64%. We always break out that REIT portfolio or that real estate investment trust piece. If you look at just straight up equities, we're at 60.37%, and the REIT portfolio is 3.78%. And then the fixed income there is listed at 29.8, and the cash portion is 6.06%. Any questions on any of that at all?
Nope.
Okay, up in the top right-hand corner is kind of regarding the activity in the account. That chart, underneath that chart, it shows beginning market value, and I'll just do the quarter. The beginning market value for the quarter, which would have been July 1st, was $123,146,951. And then during that time underneath there, you see net contributions and withdrawals of $1,053,316. And there were withdrawals during that time, obviously for retirees, but the ARC payment was also put in at that time. And the ARC payment that we received was $3,158,684, just to kind of give some perspective. That's why it shows an addition there in that net contribution area. Then underneath that, capital appreciation or growth of $7,097,963. And then the total balance as of the end of the quarter, Mike will have up-to-date numbers. At the end of the quarter was $131,298,230. So any questions on that at all?
Just maybe with the activity in the stock market, do we have any hope that the ARC may be reduced a little bit?
Is that a question to us, Commissioner?
Well, or Bob Metley, I'm not sure if he's.
I would think because the ARC was calculated on 131 million at the time we turned it in. So if at the end of the year, the balance is higher, I would think that it would be less. Now, how much less, I couldn't guess, but it may be a surprise like it was the other year when we were, 600,000 less. So if the market continues, it definitely will be less.
And the other question I had, did we punt on the assumption change the last time we talked about that, with the...
No, we changed to 7.25.
We did move it a little bit.
Yes, we moved it to 7.25.
Yeah, that's right. We didn't go the whole way, but we went.
Right.
Okay, thank you. That's all I got.
Okay. And then one other point we just wanted to mention was at the end of the year, we always like to bring up the investment policy statement just to kind of get that refreshed and see if there's anything that needs updated with that. After this meeting, we're going to forward that over. Jamie, if it's okay, we'll send it over to you. And then typically we would ask the board to review that if there's any changes or recommendations that you all would have with that. If not, maybe in the February meeting, we can just get a signed copy just for all of our records and so on. Mike and I, we have no recommended changes at this point ourselves with it at all. Then the last thing, I'll hand it over to Mike, and then we'll have Corie and Brett share a little more specifics. Go ahead, Mike.
So just to give you
I got a quick question before Brett goes, Mr. Chairman.
Yeah, go ahead, Jamie.
Going back to the return, we have the quarter to date, year to date. Do you have from the end of the quarter to now? Do you have the updated return number? If you did, I'm sorry, I missed it.
Yeah, that's right. That's what Mike's going to share right now.
Oh, okay.
Yeah.
Come on.
Yeah, thank you. Yeah.
Good tee up there, Jamie.
So again, these numbers I'm going to give you, these are not audited numbers. Obviously, it takes a little bit of time after the quarter end to get those audited numbers that just went through. So these are unofficial, but they should be pretty accurate. So the balance through November 17th was $137,293,123.
Wow.
Okay, so we've had October was down a little bit. Again, the lead up to the election, I think, had a lot to do with that. Some uncertainty there, what direction that was going to go in. But the month of November here has really been strong. What that does give us, again, unofficially, is the return now is at 7.08%. Wow. And again, the net number for the year, as far as withdrawals, is $3,871,946.
All right. Very good.
Allocation wise, equities have grown a little bit, obviously, from the numbers I just gave you. So pure equities, taking out the REIT piece, we're at 62.56%.
I think Commissioner Litz had a question, or she's having difficulty hearing.
My pen quit right when you started to say what amount we have today. And could you repeat that amount? 3 million?
So the withdrawal amounts year to date, the net withdrawal amounts is $3,871,946.
Oh, that was a withdrawal. Okay, so you didn't get to the bottom line yet.
Yeah, that was first.
I'll get that to you again. The balance as of November 17th, $137,293,123.
Okay, thank you.
Sure.
And that's awesome.
I don't know, Mike, if you have a microphone that's further away, maybe you could bring it closer because there's like an echo. And my hearing is a little sensitive. It's hard to distinguish your numbers. Just for the future, if you think of that.
We will.
Okay. Yep.
Thank you.
Regarding the allocation, we are slightly outside the typical range within your investment policy on the equity piece. 2.5%. It's not a lot. So we would probably recommend that we just stay there for now. Fixed income, we're unfortunately not getting paid very well. It's hard to make a return. And I think when we come back in February, we'll revisit that. If we're still outside that range, then we'll probably consider, getting it back more in line with the investment policy. And we do have that ability within the investment policy to stay outside that range for a period of time, I think is the wording. So we'll just consider that at that point. See where the ranges are from that standpoint. So any questions with the up-to-date numbers?
Nope. Keep up the good work with that. That's great.
As I mentioned, we'll send over the investment policy to Jamie for your review and just to get it up to date, get that document up to date for next year. Okay.
All right, you want to continue?
And with that, we'll ask Corie to join us here. Corie again represents, he's one of the managers again with the Clearbridge large cap growth piece, which represents a little over 14% of the overall pension. So with that, Corie, we'd be happy to hear you share your remarks.
Great. Thank you so much. And thanks everyone for having me. Just quickly, I wanted to kind of set the stage. Is it helpful, most helpful if I just kind of go over where we were thinking from an economic perspective and then go right from there, right into the portfolio and how we performed and what's done well, what hasn't for the year?
That's fine with me. Yeah.
Great. Great. So from an economics perspective, we are still very, very positive on the broader economy, but maybe not quite as positive as some of our peers. We think growth will continue, to be clear, but we just think the pace of growth will start to slow a little bit. So if we back up for a second and think about where we've come from, we entered 2020 coming off of a year, 2019, where the S&P 500 was up over 30%. And markets were really priced to perfection. So as portfolio managers, we were kind of looking at the strategy and trying to de-risk wherever possible, given that markets had run so significantly. So for those of you who are familiar with price to earnings ratios, the price to earnings ratio on February of this past year was 19 times. If you're not familiar with price to earnings ratios, it's essentially like a price tag for the stock market, and 19 times earnings is relatively expensive for the broader stock market. So we were trying to be cautious of the fact that markets really had run significantly into 2020, and we were trying to de-risk the portfolio wherever possible to protect on the downside. And we were seeing some signs of slight weakness in the broader economy. So we were a little bit contrarian in that regard. Jump forward to March, we were right for the wrong reasons. We did not predict a pandemic, believe it or not. So the sell-off was a little frustrating for us. Given that we were positioned in a defensive manner, we thought the portfolio should have done better in that environment than it did. The reason it did not was because stocks that are typically extremely defensive, think consumer staples and the like, were not nearly as defensive as they would historically be during a pronounced drawdown of that magnitude. But tech stocks, ultra high growth stocks, actually were very defensive. So we had been reducing exposure to those sorts of names. So even though we were right, and again, we were right for the wrong reasons, even though we were right, the portfolio didn't behave the way we would have liked the portfolio to have behaved. Coming out of that, so jumping forward to where we are today, we do believe that the market has really underappreciated the zero cost of capital environment. So we all hear all the time how low interest rates are. That's a really powerful thing for growth investments, because when interest rates are as low as they are right now, growth is extremely easy to come by because borrowing capital to invest in your business is extremely cheap. So right now, growth is the place to be in our opinion, but we don't think that low interest rate environment that has facilitated growth over the last several years and will likely continue to facilitate growth over the next 12 to 18 months, we don't think it'll be here forever. So those ultra high multiple stocks, so think of Facebook, Amazon, Netflix, Google, we own most of those stocks in this portfolio, but we are trying to be mindful of the embedded risk that those stocks present. So we have actually exited Google this past quarter in favor of overweighting Facebook, and I'm happy to discuss that in more detail. We don't own things like Tesla. Instead, we'll own things that play into that similar theme of connectivity and electric vehicles, but we will own them in a name that is much cheaper than 100 times price to earnings ratio. So again, that's that valuation. The broader market is around 19 times and Tesla is at 100 plus times. That's extremely expensive. And in our opinion, if you're wrong on Tesla, the downside is way more pronounced than the potential upside. And that's how we look at the world, downside versus upside. And we want to balance those two things. We don't want to get out of our skis and be too kind of momentum oriented. Because if we are wrong, it's going to cost a lot of money for us being wrong. So where it stands today is we've actually positioned the portfolio for more up capture, which means we're more pro-cyclical. We think the economy is going to continue to go higher. We've reduced diversification within the portfolio in terms of the number of names. So we've concentrated our bets into fewer names, but those names are names that we think will do well in a lower growth environment. So we think growth is going to continue. We just think that the pace of growth is going to slow and the market is going to broaden out. Instead of just looking at these ultra high growth names, these lower growth names that are trading at more reasonable valuations will come more into vogue, and the portfolio, we think, will benefit from that significantly. So jumping to the quarter, for the third quarter, the portfolio itself was up around 12.5%, and our benchmark, the Russell 1000 Growth Index, was up about 13%. So we kept pace essentially with the market, and the reason we didn't outperform the market was the exact dynamic I was just mentioning to you. Not being ultra overweight, the ultra high growth names has obviously depressed performance. So for example, one of the biggest detractors for the quarter, or the biggest detractor for the quarter from a sector perspective, was consumer discretionary. Now, not owning Tesla cost us a significant amount of relative performance. And again, Tesla was up 99% in the one quarter. That would be lovely if you owned it, but if you're wrong and that goes down, that's going to really burn you. And Tesla's at 100 times price to earnings. So that costs us about 90 basis points, or almost 1% of performance. But we do own names like Aptiv and NXPI. So Aptiv is about 1% of the portfolio. That's at 28 times earnings, and that develops safety features for advanced auto components. So something like a high voltage harness that will play in the exact same arena as Tesla, but in a way more risk adjusted way, in our opinion. Same thing with NXPI. It's a semiconductor name that supplies essentially what can be thought of as the brains for electrical content within vehicles. Vehicles is 50% of NXPI's revenue based on 2019 revenue, and that's trading at 17.8 times earnings. So significantly lower risk, in our opinion, embedded in those names, and you play the same themes that you would play via Tesla. So that's kind of where our head is at so far in terms of portfolio construction. Just really quickly going through performance, and then I'll turn it over for questions. Information technology was another large detractor. We have a lower weight in information technology than our benchmark does. That is not a broad-based opinion that infotech is not the place to be. We love information technology. We, again, are just underweight those ultra large growth names, which has kind of made us look relatively underweight to the benchmark. But we do own a lot of smaller names that you maybe don't hear of every single day that are doing extremely well in that space. So names like Salesforce up 34%, NVIDIA up 40%, Qualcomm, and NXPI, which we talked about, have all done really, really well. And then in terms of what has worked, industrials has worked very well for us. We had names like C.H. Robinson that were up 30% for the quarter. And if you're not familiar with that name, that's a trucking logistics company. And this kind of gets to the way we think about the world. It's easy to hang your hat on names that have done well, like C.H. Robinson. But for us, if a name's up 30%, it actually warrants us reevaluating that name. And since the end of the quarter, we've actually taken the opportunity to harvest our gains in that name and get it out of the portfolio completely. Because at the point it's trading now, we think it's reflecting full value, and we think we could do better in terms of upside, downside risk elsewhere within the portfolio. And in terms of other areas of the market that did well for us, communication services. So selling Google was actually positive for us on the quarter. Owning more Facebook was positive for us in the quarter. And then healthcare was another area of relative contribution to the portfolio. And then rounding that out, we had real estate, which is a small exposure for us. And that's more Equinix, which is a software real estate company. And in our opinion, that's more of a tech name than a real estate name. But nonetheless, it did well for us. And then consumer staples also did well for us. And that was partly because of an underweight. So that's really the quarter in a nutshell. I know I threw a lot at you folks there. Is there any questions on anything I touched on? Yes, please ask.
I was curious. You said that you purchased, if I understand correctly, more Facebook. What percentage increase, and how's it doing?
Yeah, so Facebook is doing well. Recently, it's come back a little bit. So we sold fully out of Google, which was a pretty meaningful exposure for us. It was probably a 3 or so % position. We did not put all of that money into Facebook. So it wasn't a dollar for dollar out of Google into Facebook. But Facebook is one of our largest holdings at the moment. And in our opinion, Facebook just has more levers to pull to win in this environment than Google does. So if you look at their business mix, so what different lines of revenue do they have? Facebook has way more diversified lines of revenue that collectively have differentiated margins. And some of them are very strong other than the core Facebook product. So think of things like Instagram and WhatsApp. They have good margins and they continue to grow. Whereas Google, it's really just search that's doing well for them. And clearly they're extremely dominant within search, but all their other revenue streams are actually atrophying and their margins aren't great there. And then on top of that, margins at Facebook are just better overall. So for
How much
those
do we have invested in Facebook?
in Facebook at the moment, let me just pull up current holdings, so I'm not giving you dated numbers. It's 5.8% of a dynamic model. So your personal exposure could vary based on implementation, but it would probably be right about there.
Mr. Chairman,
Let's go ahead, Commissioner.
based on the rumblings with the social media and the, even antitrust being mentioned in regards to Facebook and some of the other social media, does that put up a red flag for you, or are you marching ahead full steam?
It absolutely does put up a red flag for us. So when we buy names or invest in names like we did with Facebook, for example, part of our process is that we'll create what we call a one-pager, where we lay out in concrete detail what we think the stock is doing well, what we think is different than what the market thinks. So what is our edge in owning this name? And then lastly, where could we be wrong? And what are the biggest risks to this name? So if there's a name that we all think is just the greatest thing ever, and there's nothing that could go wrong with this name, we'll actually go out and hire someone on the sell side research side of the Wall Street to come in and argue a negative case to us, just so we know we're not missing anything. And to your point, Facebook, that is the biggest thing that could go wrong, is a significant crackdown on Facebook's platform. The reason why we're not overly concerned about that from a long-term perspective, in the short term, that could absolutely be something that causes Facebook to have short-term weakness. But long-term, we think it's a lower probability event, because at the end of the day, these are optional platforms. And Mark Zuckerberg has been extremely clear in all the proceedings that he's been to, is that he welcomes reform. If it's done on the law side, he's not going to implement overall reform on his side. So we think that a lot of that risk has already been embedded in the stock. And on top of that, at the end of the day, a lot of these companies do hold somewhat of a trump card, in that they can say, we're just going to provide more transparency in the things that we're doing on our side. And at the end of the day, if folks don't like it, we're not holding the gun to their head. They're free to leave whenever they want.
And some are.
Exactly. Yeah, some definitely are. So something like Twitter, for example, we don't own in this strategy. We do own it in other strategies in the company. I love Twitter personally, but with what they've done lately with restricting people's ability to just share whatever they want, which, we could argue whether that's philosophically the right or wrong thing to do, but it is providing somewhat of an exodus off of that platform and onto another platform that is very similar, that's promised not to do that. So there are business opportunities being created as a result of some of this behavior.
All right, Corie, excellent report. Appreciate your time and all your explanation. And do we have anything from Mr. Agnew?
Yeah, just to mention, we mentioned Facebook, and I think, Corie, you said it's about a 5% position in your portfolio, but it's actually about a 0.86% position in the overall portfolio. So it's not just so you're aware, it's not a significant piece. It's well diversified. It's a small piece of the pension.
Okay.
Thank you all for having me very much.
Yes, sir. Thank you.
Thank
Happy
you.
holiday season.
Thank you, everyone.
Thank you.